Take a look at the futures right now. Dow off about 30 points. NASDAQ off about 13 points. The S&P 500 off just about 4 points. Joining us right now is Kevin Mein, President and Chief Investment Officer of Hennian and Walsh Asset Management. Good morning to you, sir.
Good morning, Andrew.
Okay, so here we are on Christmas Eve. What do we think 2026 could possibly look like?
Yeah, what a year this has been, right? 41 record closes for the S&P 500, a total return of just over 18%. And we reached the 3-year anniversary of this bull market run. So what do I think 2026 is going to look like? I think it's a continuation of this bull market, albeit with much more volatility than what we saw in 2025.
But does that mean we're living in you think if we're sitting here together a year from now, double-digit growth?
I think we have another double-digit growth year. But I think certain areas of the market are going to perform much better than other areas of the stock market. And if you follow the money, that's going to lead to where all of the growth opportunities are. And when I say follow the money, I don't necessarily mean where the flows are going, but where is the money being spent? And we know that the money is being spent on areas such as AI infrastructure, aerospace and defense, biotech, and of course, power solutions, the all-important power solutions that are going to keep this AI revolution going.
Is that because earnings grow double digits?
I think we're going to get a lot of earnings growth. We're going to get additional spending. And there's
so
also
the multiple
some
stays where it is. So the multiple stays where it is.
Yeah, the multiple stays where it is. It's going to be still above its 5 and 10-year averages. It is rich. And I think some of the more rich areas are ripe for a pullback. But that doesn't mean those other areas.
So it just the market tracks the earnings per share growth and goes up double digits based on, and it does that, why? Because of the big, beautiful bill, or because of the momentum in the economy, or?
Yes.
It does it in spite of tariffs? It does it because of tariffs?
I think there's multiple tailwinds. I think we have deregulation on the way. Yeah. I think we have the prospects for billions of dollars of spend on the AI infrastructure play, which will keep that investment opportunity going. And we also know that there's going to be opportunities as it relates to the market itself in terms of historical dynamics. Over the last 50 years, we've had 5 times when this bull market has hit its 3-year anniversary. All 5 times it continued to move higher by an average total duration of 8 years, Joe. Yeah. That would suggest we got 5 more years to go. Of course, this time could be different, but I do think there's more.
People are pointing out 4.3% GDP in a weakening labor market means productivity is going up. The journal says maybe is it AI?
Yeah, I think AI has a lot to do with that. If you look at 4.3% GDP growth, we have core CPI around 2.6% right now. We have wages exceeding above inflation. That's signs of a healthy economy. But we need the consumer to continue to spend. During the first half of last year, AI infrastructure spending matched the contribution to GDP of the consumer. The consumer historically accounts for about 70% of GDP growth. Right. So if the consumer shifts to servicing all their outstanding debt as opposed to spending, the economy will slow further.
The consumer she? Everybody calls it
proverbial they.
Every retail person we have on calls her she. Accurately.
I don't know where to go with that one.
I'm not going anywhere with that one.
In my
Let me ask you a different question, which is to the extent you have this thesis for the year.
Yes.
How much does it depend on the Fed getting any more sort of loose, if you will? Does it depend on a new Fed chair coming in and saying, hey, we got to go lower?
I don't think the market should be looking to the Fed for any answers in 2026. They told us after their last meeting to just expect 1 rate cut at 25 basis points this year and 1 more rate cut at 25 basis points in 2027. I take them at their word. Perhaps when the new Fed chair comes in May, we get those 2 rate cuts this year as opposed to 1 and 1. But they told us their neutral rate is 3%. We're only 50 basis points away from that neutral rate of 3% right now. So we don't necessarily need more accommodation for this economy to continue to grow.
What's the GDP next year? The administration says it can do 5. You believe 5? Would you be? Do you believe 4 is possible?
I believe 3 is possible. I think 4 is a stretch. I'd be very happy to see it, but a lot of things have to go right for us.
Will people be cranky about the economy next year, like supposedly they are right now?
People seem to always be cranky about the economy. People always find reasons to be concerned, whether it's the upcoming deadline for the federal government.
They can't buy groceries. They're really.
Of course.
Can they buy groceries easier with wages rising?
Of course they can.
So maybe that'll help.
That will certainly help. Shelter costs coming down will help. Lower energy costs, all of that helps, Joe.